Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to video number 4 of my 10-part video series on tax planning for the year-end 2024. As mentioned in video number 1, starting January the 15th, 2025 and running through April the 15th, 2025, I will be hosting a 2024 tax return preparation class. This is where all the action is going to be on the channel for the 2025 tax busy season. If you're interested in that, there is a link to get signed up in the description below this video. Alright, in this particular video number 4, we're going to expand on the 401k and IRA tax planning that we discussed in video number 3 by talking about the Backdoor Roth and the sort of related Mega Backdoor Roth strategies. So right here we have Bob and Sarah. Now Bob and Sarah want to each make a contribution to their Roth IRAs, let's say in 2024. And they know that generally folks can make contributions to Roth IRAs up to $7,000 or $8,000 for each person who is over 50 years of age. Note that the $7,000 and $8,000, if you are over 50, contribution limits are applicable to both 2024 and 2025. But there's a problem here. Bob and Sarah make too much money. So right here I have some handy dandy charts that I pulled off of Fidelity, and let's use these charts to define what too much money, quote unquote, means for purposes of making Roth IRA contributions in 2024 and also over here in 2025. So for single individuals, the top of the threshold or the top of the phase-out range, or i.e. too much money, is defined to be $161,000 of AGI. Over here in 2025, that threshold goes up to $165,000. For married filing joint, the top of the threshold is $240,000 in 2024 and $246,000 in 2025. So the way to read this chart is if you are married filing joint, then under $230,000 of modified adjusted gross income on your tax return would mean that both individuals, in this case Sarah and Bob, could contribute $7,000 to a Roth IRA. Between $230,000 and $240,000, some of the contribution is phased out, thus resulting in a partial contribution being allowed. And then above $240,000, no contribution is allowed to a Roth IRA. It is fully phased out. So as I mentioned in the previous video, there is no income limit to contribute to a traditional IRA, although there may be an income limit to deduct the contribution. With Roth IRAs, which is what we're looking at right here, there is an income limit just to make a contribution at all, and that's what these numbers represent right here, the income limit. And so that's what too much money, quote unquote, means for purposes of making Roth IRA contributions. So since we are assuming that Bob and Sarah make in excess of $240,000 of AGI in 2024, they need another strategy in order to get money into a Roth IRA. And the first possible strategy is called a Backdoor Roth IRA conversion. Now let's be very specific. A Backdoor Roth IRA conversion means that a person makes a non-deductible contribution to a traditional IRA, and after they make that contribution, they do a Roth IRA conversion in order to get the money into the Roth IRA. In other words, because the couple has more than $240,000 of AGI in 2024 and therefore cannot make a Roth IRA contribution directly, they make a non-deductible contribution to a traditional IRA because there is no income limit preventing that, and then after completing that, they convert it into the Roth. So for example, Bob could make a non-deductible contribution to his traditional IRA of $7,000, and then he could convert that $7,000 into Roth. And then Sarah can do exactly the same thing. Remember that IRAs, whether traditional or Roth, are tracked and handled separately by individual regardless of whether they file a married filing joint tax return. Okay, assume for the moment that both Bob and Sarah had $0 balances in their traditional IRAs before the $7,000 non-deductible contributions were made. In that situation, would there be any tax triggered on the conversion to the Roth IRAs? And the answer is no, because the $7,000 was a non-deductible or after-tax contribution to a traditional IRA. The tax had already been paid on those particular contributions of $7,000 each, and therefore the conversions would not trigger any additional tax. So that seems pretty straightforward, right? And a simple way to circumvent the rule that prevents direct Roth IRA contributions because of income level. But there's a catch with this strategy, and there usually is with the tax law. The catch is called the Pro Rata Rule, and it works like this. Assume that instead of a $0 balance in their IRAs prior to the transaction at hand, Bob had a balance of $70,000 consisting of pre-tax contributions in his traditional IRA, i.e. contributions for which a deduction had been taken on the couple's tax returns in prior years, and Sarah had a balance consisting of $50,000 of pre-tax contributions and $20,000 of after-tax contributions. So after the transaction at hand, Bob's and Sarah's IRAs would consist of the following. Okay, so we're over here on the Pro Rata Rule tab. Let's walk through this example. So here's Bob's traditional IRA, and the pre-tax balance from all prior years, PY means prior years, is $70,000, and he did not make any additional pre-tax contributions in the current year. Bob's after-tax contributions from all prior years was $0, and he made a $7,000 after-tax contribution for the current year. So in total, in Bob's IRA, we have a pre-tax total of $70,000, and we have an after-tax total of $7,000 for a grand total of $77,000. Then over here in Sarah's IRA, she had pre-tax contributions from all prior years consisting of $50,000. She had after-tax contributions from all prior years consisting of $20,000. She made a current year after-tax contribution of $7,000. So she has a pre-tax total of $50,000. She has an after-tax total of $27,000 for a grand total of $77,000. Now, what we're going to do right here in these percentages is we are going to figure out what percent of the total traditional IRA value relates to pre-tax contributions and what percent relates to after-tax contributions. And to do that, if I click on this cell, I'm just going to take the pre-tax total divided by the grand total. Same thing right here, after-tax total divided by the grand total. So about 91% of the contributions in Bob's traditional IRA represent pre-tax amounts, and about 9% represent after-tax amounts. Same concept over here with Sarah's IRA. However, because her starting balances for pre-tax and after-tax were different, her calculation results in about 65% of her traditional IRA relates to pre-tax contributions, and about 35% relates to after-tax contributions. So let's go down here to the conversion analysis. Now, both Bob and Sarah plan to convert $7,000 apiece in this backdoor Roth strategy. But the Pro Rata Rule does not allow them to convert this specific bucket of $7,000. They can't just put this $7,000 in and then convert this specific $7,000 over to Roth. What they have to do is take the total amount of the conversion and they have to multiply it by the percentage that relates to pre-tax amounts and the percentage that relates to after-tax amounts. So if I click on this cell right here, it's taking Bob's $7,000 conversion and multiplying it by 91% to indicate that of the total $7,000 converted, $6,364 is going to actually be deemed to come out of the pre-tax total. And then right here, 7,000 multiplied by the 9%, only $636 of the conversion will be deemed to come out of the $7,000 after-tax bucket. Over here with Sarah, same concept. If we multiply the 7,000 by this 65% right here, it indicates that $4,545 will be deemed to come out of the pre-tax total, and then $2,455 will be deemed to come out of the after-tax total. And so the pro rata rule caused these amounts right here to become taxable in the current year. So to say that in summary, the pro rata rule does not allow you to contribute these $7,000 amounts and then earmark them so that they are specifically the amounts being converted. Once you put any after-tax contribution into a traditional IRA, it's basically all lumped together, both pre-tax and after-tax, from the perspective of the IRS. You are required to keep track of the different buckets within the IRA yourself, and then any distributions, including a Roth IRA conversion, which is just a distribution, has to come out of the IRA pro rata based on these percentages right here. And that's the big downside to the backdoor Roth. The Roth conversion rules require you to convert a pro rata amount of the pre-tax and the after-tax portions of the traditional IRA balance. So in Bob's case, for example, he paid tax on the $7,000 non-deductible contribution to the traditional IRA, and then in the same year, under the fact pattern we just went over, he would pay tax on an additional $6,346 of income that was triggered by the pro rata rule related to Roth conversions. Now, it's true that since only $636 of non-taxable portion was transferred from Bob's traditional IRA to his Roth IRA, there is still $6,364 of non-taxable portion sitting in Bob's traditional. And it's true that that portion won't be taxed again. Just to make sure you're following what I'm saying, Bob had $7,000 of after-tax contribution in his traditional IRA before the conversion. $636 of that portion was converted, so that leaves $7,000 minus $636, which happens to equal $6,364 of after-tax contribution remaining in the traditional IRA after the conversion. But the benefit of that portion not being taxed again won't be realized until future distributions or conversions, whereas the additional income triggered by the pro rata rule will be taxed today. So Bob and Sarah decide that they don't like the pro rata rule. In their situation, with the majority of their traditional IRA balances being pre-tax, which is usually the case for most people, the pro rata rule triggers too much tax for their liking. But they have learned that the pro rata rule doesn't apply to the Mega Backdoor Roth. Okay, now as soon as you hear the phrase Mega Backdoor Roth, understand that we're now talking about a 401k, not a traditional IRA. Just to summarize, Backdoor Roth means traditional IRA as the starting point, and Mega Backdoor Roth means 401k as the starting point. So why doesn't the pro rata rule apply to the Mega Backdoor Roth? Well, I think the simplest answer is that pre-tax contributions to a 401k and after-tax contributions to a 401k are actually segregated into separate accounts within your plan. Whereas in a traditional IRA, those two types of contributions are commingled with each other. You still have to keep track of the pre-tax and after-tax portions separately from the actual account, but the IRA account doesn't segregate them into two different places. So when you convert from a 401k to a Roth vehicle, you can distinctly see that the funds being converted are after tax. Conversely, when you convert from a traditional IRA to a Roth vehicle, you can't tell which pool of funds the transferred portion is coming from, and thus the IRS requires the pro rata rule. So the Mega Backdoor Roth is when you make after-tax contributions to a 401k, and then you can either convert them to a Roth 401k. This is generally called an in-plan conversion. Or you can roll over the after-tax funds into a Roth IRA. This is often called an in-service distribution. But in order to be able to do a Mega Backdoor Roth, your 401k plan needs to do the following. Number one, it has to allow you to make after-tax contributions to the 401k in the first place, which is generally pretty common these days. And then it either needs to have a Roth 401k option for the in-plan conversion, or it has to allow in-service distributions to an external IRA. So again, this is plan specific, and you have to check with your plan to make sure that it allows these options in order to set up a Mega Backdoor Roth. Okay, let's assume that Bob's and Sarah's 401k plans allow these options. In this case, how does a Mega Roth conversion work? Well, to understand that, let's look at the various 401k buckets and limits. So right here we have the 401k contribution limit for 2024 and then down here for 2025. Sticking with 2024 for the moment, you can contribute $23,000 either pre-tax to a 401k or on an after-tax basis to a Roth 401k. We're going to refer to this as bucket 1. And then sticking with 2024 again, you can contribute a grand total of $69,000 in the form of after-tax employee contributions and or employer contributions into a regular 401k only. This bucket 2 does not apply to the Roth 401k. So let's summarize. You can contribute $23,000 to a 401k or a Roth 401k for 2024. And because you can contribute $23,000 to a Roth 401k directly, then the Mega Backdoor Roth conversion isn't even a thing until you have already filled up bucket 1. In other words, there would be no reason to contribute $23,000 to a 401k and then convert it to a Roth 401k when you can just contribute $23,000 to a Roth 401k directly. This is why you will read or hear people say the Mega Backdoor Roth only comes from after-tax contributions to the 401k, meaning that you could put pre-tax $23,000 into a regular 401k, and then only additional amounts that you put in after tax are going to be part of the Mega Roth conversion. So let's set up the buckets slightly differently than above, just for clarity. So starting right here using the Roth 401k, you can make direct contributions of up to $23,000 in 2024, but no additional contributions can be made directly to the Roth 401k. In other words, once you put $23,000 in here, there is no more room. There is no more additional bucket up here. Conversely, with the 401k, you can contribute pre-tax up to $23,000 in 2024, but then the 401k can be filled beyond the $23,000 of pre-tax contributions with a combination of either employer contributions or your own after-tax contributions up to $69,000 total in 2024. And it's your own after-tax contributions right here that are critical for purposes of this discussion. Now enter the Mega Backdoor Roth. Assume for the moment that there was no employer match in this situation. In that case, you could contribute up to an extra $46,000 to your 401k after tax and then do an in-plan conversion to Roth. To repeat that using the picture, you could contribute first this $23,000 pre-tax tax, assuming no employer match, you could then contribute $46,000 after tax and then convert it over here to Roth. Now, next example, assuming an employer match which totaled $10,000, you could then contribute up to an extra $36,000 to your 401k after tax and then do an in-plan conversion to Roth. So in other words, the employer match would use up some of your additional $46,000 bucket. Now, I do want to note right here that under Secure 2.0, employer match going directly to a Roth 401k is allowed, but lots of plans are not set up for this yet, so it's kind of a new thing that you don't see very much. For now, and for purposes of the examples that we just went through, we are assuming that the old rule, where the employer match can only go into a pre-tax account and historically was not generally allowed to be part of the Mega Roth conversion. If your plan does allow this direct employer match into the Roth 401k, and your goal was to max out the Roth 401k as much as possible, you would probably want to make a direct contribution of $23,000 to the Roth 401k, have the employer match be directed in here as well. Then there would be no employer match to reduce this $46,000 bucket, so you could put exclusively your own after-tax contributions in here and then mega backdoor the whole thing into the Roth. That would probably be the method to maximize the amount in the Roth 401k, assuming that your plan allows this right here. And then finally, I want to note that the same transactions as above that we just went over can happen with an in-service rollover to a Roth IRA, assuming that your plan allows that. So that's the basics of the Backdoor Roth, as well as the Mega Backdoor Roth, as well as the Pro Rata Rule, which we learned only applies to the Backdoor Roth. Now, assuming that you're interested in one of these strategies, remember that even if you can't get it done in the current year, let's say 2024, because you haven't contributed enough to your 401k or you just don't have time or whatever, now is still a great time to start thinking about it so that you can start early, let's say in 2025, planning this strategy out for the year. If you wait until the end of 2025 to start thinking about it, it may be too late again and you won't be able to do it until 2026. Also, could 2025 be the last year when the Backdoor Roth and the Mega Backdoor Roth are available strategies? Who can say at this point? After the April 15th tax busy season is over next year, we will be heavily analyzing what proposed tax law changes are coming down the line under the new Trump administration. There have been many things proposed, but almost nothing in terms of specific details has yet to be announced as of the making of this video. So we'll be looking at that and incorporating it into our tax planning for 2025 if applicable, but certainly for 2026 and beyond. Also remember that my 2024 tax return preparation class kicks off on January 15th, 2025 and will run through April 15th, 2025. We will have lots to talk about in that class, lots of details to get organized and work through. So if you're interested in participating in that, you can find a link to sign up in the description below this video on YouTube. And that's going to be it for today's video. Thanks for watching, and I'll see you next time.